Another day and another paper price smash in gold and silver futures contracts. Unfortunately, this has been very common for weeks now. The gold and silver prices have been smashed anytime they get above $1,900, and this is in spite of the dollar index not rallying too much. It is above 90 right now. It's not back to 91 yet, and the yields on the 10-year U.S. Treasury have only risen about 30 or 40 basis points. I don't think they're going to go a lot higher. There are people talking about yields going much higher. I don't think the Fed will allow yields to go much higher. We are headed, unfortunately, towards Japanification. The Fed is going to have to monetize and expand its balance sheet a lot more and buy up a lot of U.S. Treasuries because the Fed is the buyer of last resort, and the U.S. government, broke Uncle Sam, or drunk Uncle Sam, as my friend George Gammon says, cannot afford higher interest rates. So there is a short squeeze, in my opinion, developing with a lot of these gold stocks. There was an article that came out in the last couple weeks about the short interest rising on gold stocks. So there is a lot of physical demand for gold. It's not helping the paper price now, but if you talk to your gold bullion dealer, there is still strong premiums, and a lot of retail products are not available for a lot of physical gold and silver. The U.S. Mint sales are still very strong for both gold and silver, especially silver. And we're starting to see both central banks pick up with their gold purchases, and also the data that's coming out of China lately for January. We're starting to see a pickup in physical gold demand again with Shanghai Gold Exchange and other data points. And I think that's probably because of the Chinese economy improving, although China has stockpiled a lot more commodities than gold. But there's been rumors for months now that China is stockpiling massive amounts of silver, but it looks like China's gold purchases have started again, whereas they were stockpiling other commodities. Now they're starting to stockpile gold. And a lot of it has to do with China's economy improving as they're exporting massive amounts of stuff again, although probably not as much high-end stuff because the U.S. consumer and the European Union consumer is pretty much tapped out, and many affluent consumers, according to the data I've seen, are not spending. But a lot of middle class and working class and poor people are not consuming anywhere near the amounts because they don't have jobs and don't have savings. But we are starting to see physical gold demand in China. So you have Chinese New Year, which is coming up. And historically, in terms of gold seasonality, that is normally a very, very good time for gold demand. Normally that about 6 to 8 week period prior to Chinese New Year is historically very good for the gold price, and probably another reason why the paper price smash is occurring. But it looks like we are going to see a short squeeze develop, as we've seen according to this article that you can see there on your screen. And real interest rates also, besides the article, real interest rates are still deeply negative. So even though we've seen a spike in nominal yields, yields are not going to be rising that much. So as you can see there on your screen in the upper right hand chart, yields are still negative if you account for a real inflation rate, not the phony consumer price index. But even if you use the consumer price index, real yields are still deeply negative, below zero. The black line, the solid black line I put is zero, so it's still deeply below there, even with a spike in nominal yields. But this is setting up for a short squeeze in gold stocks. So the fourth quarter, Q4 2020 numbers should be out for a lot of these gold miners and gold stocks in the next month or so, and we should still see spectacular numbers for earnings and profit margins for a lot of these gold miners. The two best gold miners right now in terms of dividend yield, balance sheet, margins, and industry-wide, according to some of these gold analysts, the profit margins are still $800 an ounce to $900 an ounce for many producing gold miners. So those profit margins are still at record highs. But you have dividend yields now, and this shows how good of a bargain some of these gold miners are, with rising short like Newmont Mining, which has a 2.5% dividend yield, and then you have Agnico Eagle, which has a dividend yield at exactly 2% as of this weekend. So those are two extremely well-run gold miners that you are getting paid to wait. They're selling at reasonable valuations, and their earnings should be very, very solid along with their profit margins, and the shares have come down. So you're going to get paid to wait. So there's not many companies and many industries like a Newmont Mining or Agnico Eagle, where you're going to get paid a 2% dividend yield or more, whether the company does not have a massively leveraged balance sheet. A lot of companies right now that are paying pretty high dividends have a lot of debt on the balance sheet, and the gold miners, that is not the case. So people would be paid to wait if they accumulate shares of Newmont Mining and Agnico Eagle. So some of these gold stocks, the short interest, if you read the article, the short interest when the article came out, which was January 5th or 6th, so it's a little over 10 days ago, but the short interest was already rising to 25-30%. The short interest on some of these gold stocks is going to be up to 30 or 40% now. So there's been a massive spike in short interest in the gold stocks in the last 6 to 8 weeks. So this will set up for a short squeeze when the Fed's balance sheet does start to increase again, because the Fed's balance sheet has been stuck around 7.2, 7.3 trillion. It's a little above 7.3 trillion now for months now. So it hasn't done very much. The Fed's balance sheet has not increased massively yet, but we are starting to see other countries, their central banks, start to announce increases in physical gold. And so this will catapult things up. Now, Fred Hickey also on January 15th put out some analysis of the commitment of traders. I'm going to read his Twitter. Today's commitment of traders report, so this is from January 15th. Gold showed who's been behind recent gold sell-off, which was levered futures and options traders. Managed money, mostly hedge funds, had enormous 5-day drops in their net long contract positions. Both futures contracts minus 38,000 and futures and options minus 47,000 fell by a third. The huge drop in managed money net gold futures and options contract positions was even more than you'd hoped for, equivalent to 144 tons of gold dumped in 5 days, and these numbers don't include Wednesday's and today's dumps, managed money, and also Friday's dumps, and then what has been occurring over the weekend, attempted paper price smashes for the holiday here in the US, Martin Luther King Day. Managed money futures contracts are at the lowest level since May 2019. Now remember though, a lot of this managed money was the short-term leveraged speculators, the specs on the futures options contracts, and the bullion banks have covered. So there was a lot of covering by bullion banks. So we're starting to see covering in the futures market by the bullion banks on the shorts, and we're seeing a rise in short interest for a lot of these gold mining stocks. And these gold mining stocks, the underlying businesses are doing extremely well in spite of the paper price smashes, because the profit margins are still very good. The dividend yields for a lot of these companies are starting to look very, very attractive, and I already mentioned 2 of them. And the Q4 earnings are going to be excellent, I suspect, that are going to be coming out with the announcements over the next month for Q4 2020. And it's going to keep going like that, because at some point gold's going to bottom, because these central bank balance sheets are not going to stop increasing. Unfortunately, it looks like the central bank balance sheets in 2021, especially the Fed's balance sheet, because of the size of the budget deficits that the US government is going to run, are going to be enormous. Now, there may be a temporary rally in the dollar, but it's probably going to be short-lived, given that I do not see demand for US Treasuries massively increasing outside of the United States, and I do not see the federal government cutting back. In fact, the exact opposite is happening. Bernie Sanders is going to be in charge of the budget, or one of the people in charge of the budget. And now that the Democrats have a slight majority in Congress, they're talking about larger and larger amounts of checks and handing out checks to people. So this is going to get crazier and crazier, the amount of currency being spent and credit being given out. And the Fed's balance sheet, it has not done very much for over 6 months. It's going way, way higher. And the gold price is correlated, heavily correlated, to an increase in the Fed's balance sheet. So as the Fed's balance sheet goes to 8 trillion, 9 trillion, 10 trillion, and above 10 trillion, the gold price is going to react to that in the not too distant future. So you can get paid to wait and wait for this short squeeze in capital gains with some of these gold stocks. And then you could get paid to wait with shares like Newmont Mining and Agnico Eagle. And these are extremely well-run businesses. Agnico Eagle's CapEx just came down as they just brought on a new gold mine. So they don't have to pay enormous CapEx to get the mine up and running. And now the costs to mine are going to come down The margins are going to improve and the free cash flow is going to be robust. And that's in spite of the paper gold price dropping below 1900. And maybe it'll even test 1800. But again, the gold miners, some of them, especially the producing ones, people are going to get paid to wait. I've looked at a chart comparing a lot of these gold mining stock indexes, and shockingly, over the last 6 months, the junior gold stock indexes are actually up, whereas a lot of these producing gold miners, either the individual shares or a lot of the producing gold miner indexes like the Sprott Gold Miners ETF, SGDM, and the GDX, Newmont Mining's flat basically over the last 6 months according to this chart, and some of these other gold mining stock ETFs are down between 8 and 16%. But the juniors have shockingly, I think it's probably speculation and marketing, but the underlying businesses for a lot of these gold stocks and gold miners are doing absolutely superbly despite the paper price smash. But you have a lot of these hedge funds and short-term traders shorting the crap out of these gold stocks, the producing ones, the ones who are minting money, the underlying businesses, and gold miners that are literally minting money and raising dividends. Over the long term, this is not going to be the case. The gold price is going to bottom. The miners are going to continue to mint money. The dividends, according to a lot of these producing gold miners like Newmont Mining and others, are very, very sustainable unless oil prices spike rapidly and gold prices continue to go down. So I think we should see in the next 6 months or so, we should see a big, big reversal on this. Please consider becoming a patron over on my Patreon and chipping in $5 or more per month, so that way I can continue to do my research and make unique content and be able to make a living. Because with my YouTube channel, my Google AdWords revenues have collapsed almost to zero. My YouTube channel subscribers have stopped growing in the last 9 months. There's no growth there. And my live stream shows have been shut down, and YouTube tech support is giving me all types of excuses, claiming that they did not put a strike on my account, even though I can't edit the title for a live stream show. I cannot turn monetization back on. I cannot even turn live chat back on. That's how bad things are with the live stream show. I have almost 150, and hopefully soon it will be over 150 unique pieces of content behind the paywall on Patreon in terms of well-researched articles. Some of the articles have taken me many, many hours to produce for lots of different topics about gold miners, silver miners, precious metal royalty and streaming companies, a lot of articles about the oil industry and other commodity industries, also global macro related articles. There's also audio podcasts and a lot of stock charts and technical analysis there too. And while you are getting unique content, if I go over 1,200 patrons and I stay there, I will sign up for another live streaming service just for patrons. So I will make this pledge, I will make this promise if I go over 1,200 patrons and I stay there. So if I drop below 1,200 patrons, the promise is not going to stay. I have to stay at 1,200 patrons and stay there. I will start to do live stream shows just for patrons behind the paywall there. Will require additional capital. I will have to sign up. I think it's $100 a month for another service there to integrate with Patreon, to sign up there and integrate. So that will be an additional added bonus for patrons if you want to take me up on that. But please chip in if you can, as YouTube is basically trying to make this impossible for me to grow my channel or to make a living from making content.